Let's get back to the biggest news in Nigeria today. The Monetary Policy Committee of the Central Bank delivered a surprising 150 basis points increase in headline interest rate to 13%. Members of the MPC voted for an increase in the policy rate, but were divergent in their decisions as to by how much that should happen. Let's take a listen to the Central Bank Governor, Godwin Emefiele.
After carefully reviewing the developments of the last 2 months and outlook for both the domestic and global economies, as well as the benefits and downsides of each policy option, the committee decided to raise monetary policy rate, the first in 2.5 years, to rein in the current rise in inflation, as members were of the view that the continued uptrend may adversely impact growth. The bank further reaffirmed its commitment to continue to provide support to priority sectors as the need arises to support growth until the current upward pressure in price development abates. The committee therefore decided by unanimous vote to raise the monetary policy rate. 6 members voted to raise the MPR by 150 basis points, 4 members by 100 basis points, and 1 member by 50 basis points to 13.5%. In summary, MPC voted to 1. Raise MPR to 13%, 2. Retain a symmetric corridor of plus 100 and minus 700 basis points around the MPR, retain the CRR at 27%, but also urged the management to continue to use its discretionary powers to mop up liquidity where they find it, to ensure that we maintain a very tight monetary liquidity in the system. And 4, retain liquidity ratio at 30%.
Sitting down with me now to read the tea leaves of the latest interest rate move by the Central Bank of Nigeria is Steve Osho. He's the CEO at Commercial Partners Capital. Good evening to you, Steve. Welcome to the show. Let's get the conversation started. This is a big jump. I said it's out of the blues. Was it out of the blues for you at Commercial Partners Capital?
If I want to give you a quick answer, I would say no. Right? No, because in the sense that this has been expected. Okay, and I think it's coming at the right time. I don't know if you watch football.
I do sometimes.
Okay, did you watch the last game, Liverpool and Aston Villa?
Now you're going to look, you're looking for trouble.
Okay, I think I'm just trying to use that to start on a light note. Yes. You know, at the point, the pressure was on Man City because they actually needed to win that match to actually win the league. No, but at the point, they were down 2-0. And the coach had to come with a new strategy by substituting about 2 or 3 players, and they made a difference in that match. You know, and they deflect the pressure back to Aston Villa, which gave them the trophy for this season.
Well, when you're done with the market, you're likely going to end up in the European League.
Maybe.
Most likely.
You know, so
I'll keep an eye on you.
That'll be good. You know, why I say that is because, you know, if you look at all the numbers we've seen across the world, you know, the Fed have reacted to that in terms of inflationary pressure. You've seen
the Bank of
US, yes. You've seen BOE responded at the same way. You've seen the inflation rate at 40-year high in the US, right?
In the UK,
exactly. No, US 40-year high, yes. At 8.2. You know, and what happened is that once you have this kind of transitory issues when it comes to inflationary pressure, you have to react. And we've been seeing a lot of Fed, you know, a lot of central bank of the world actually reacting to this. And consequently, this is actually the 3rd MPC meeting this year. And we've seen that increase in inflation this year for the 3rd time that has actually accelerated. And what we witnessed the last April, which printed at 16.82, compared to what we had in the previous month, which printed at 15.91, was actually the steepest we've seen since last year, August. So which means that you need to react to this point. And that's the reason why, at this point, we're actually not surprised. We had a meeting on Monday where we're actually analyzing the market and trying to see how the CBN will react at this particular MPC.
Well, how do you think the MPC would have decided? 50? 100?
Well, I think, like I said, the rate of increase is what is actually at stake here. So whether it's going to be 50 basis point, 100 basis point, 150 basis point is what most of the market analysts did not get right. Okay? But I'm not surprised because based on the analysis I just did now, I think is actually a very tough time and we have to actually respond. If you look at interest rate at 4%, 5% on yield on T-bills, you see bonds at 13% and you see inflation trading at 16.9. Something has to give. It's just a matter of time.
So you think the central bank or the MPC just decided to bite the bullet? Rather than do 50-50-50, just take it out of
Well, I think this is just one of the subsequent moves they're going to see going forward into 2022. I think it's the right time to do it. And if you look at the last MPC meeting, the numbers of people that actually clamoring for increase in MPR has actually increased. And at that point,
among the 11
we
members,
felt, yes, exactly, among the members. And at that point, we felt that, something is going to give. So this time around, we're not surprised.
But here we were with 6 consecutive GDP rates, growth rates over the last 6 quarters. We came in with 3.11% this year. So perhaps some folks could say, well, that growth is here. The central bank, the MPC had always said, let's wait and see. And you think we've got to that point now which this has to happen?
Well, if you look at the growth in the GDP, yes, even though it has grown year on year, but if you look at what we got this time around versus what we had in the last quarter in 2021, it was actually lower. We got 3.9 and they actually printed at 3.1 this time around. So which means that the economy is slowing down. And we all know the reason for that. There's been a lot of issues in terms of all these transitory issues we have from inflationary pressure coming from Ukraine-Russia war, coming from the high price in energy, coming from food, high food cost and stuff like that. So I think it's beginning to actually bite harder and people actually can feel it even from income perspective, from household income perspective.
This is a huge interest rate hike, the first of its kind, not in 1, 2, 3 years. So how will it be felt on the broader economy? What are your permutations?
The first is 6 years, actually. The last time I actually saw that increase is in 2016. And we saw that trajectory moved up over a period of time. And 2018, don't forget that in 2016 we had a recession, and the government and the Monetary Policy Authority had to respond. Started going back up again, or coming down again in 2018. Then in 2020, on the back of all the stimulus package that has been pumped to the economy to reflate the economy based on the COVID-19 pandemic issue. So we saw an increase, moving up, gradually again. And I think this year has been so aggressive. In terms of the broad economy effect, I think in the meantime we're going to see the issue is that when you increase rate at this point, you don't expect to see immediate reaction or immediate effect. And most of the emerging economy is actually not the good things to do. But again, a lot of people have argued about saying, treating or interest rates when you have inflationary pressure is like using chemotherapy when you have cancer. You either use it to slow down the spread or you allow it to spread and cause more damage. So I think that's what they've done here. So broad effect, you're going to see, most time you don't see stock markets react positively to that. Probably you're going to see a downward valuation of some of the stocks. But at the same time, it probably might provide opportunity for a lot of corporates who are trying to dilute their capital because you're going to see increase in yield across all the government bonds. But what happens is that as people move away from stock in terms of investment, you see a lot of actually people tracking yield on government bond. And actually could attract few investment from offshore, providing that the enabling environment, apart from other issues that we have, that actually militating against the people from investing in the economy is sorted or is addressed.
But the higher interest rates on the economic performance itself. So if we're not going to see, let's say we have a 3-month lag in terms of the effect of this particular rate hike, 150 basis points. So anytime from third quarter, do you think we'll begin to see some impact in the economy?
I think from third quarter to the end of the year, we'll probably see some transitory effect of that on the economy. We'll probably see a slowdown in inflationary pressure. And if that happens, although there might be some slow growth, because as you're not trying to pump a lot of money into the system, it means that the cost of borrowing will go up. Well, the bank will probably benefit in actually trying to lend more, but in terms of people who are trying to borrow money, corporate, individual, you'll probably slow down. And you'll probably see a drop in the price of houses.
I'm going to ask you more questions to flesh that up for me when we return. Start by everyone. Steve Osho, the CEO at Commercial Partners Capital. We'll be right back, everyone. Steve Osho, the Chief Executive Officer at Commercial Partners Capital, is chatting to me on today's 150 basis points rate hike by Nigeria's central bank. Steve, thank you so much for your time. If we take this to this rate hike to the markets and begin to look at what's our exchange rate, how would it impact on exchange rate? Nigeria is still planning to hit the Eurobond market, perhaps $500 million later this year. And the whole interest rate issue, the war in Ukraine and all that, and you spoke about the credit market. If the headline inflation, also headline interest rate is up by to 13%, how would other assets in the markets be priced? My mortgage, for example, if I want to get credit to purchase a house or home, whatever it is. I'm not sure I like that.
Sorry, I'm laughing, but that's the reality, and that's what's going to happen. It means that you're going to reprice. And if you're repricing, it means that you're going to reprice at a higher rate, for cost of borrowing, for mortgage and stuff like that. So that's going to impact that. It's going to impact the cost of borrowing for real estate. And people want to get mortgage. So it means that you're going to actually cover more in terms of interest payment in that area. As regards the exchange rate over time, the dilemma we have right now is we don't really know what exactly we're going to use to benchmark. Because what we have as official rates is hovering between 419 to about 440 in the market, and you have the parallel market that's actually running away, which we don't know what is the cost of that. But if you ask me, in terms of, because we have reserve now at 39 billion, and there's a reason why the CBN have been trying to actually defend that over time. So it means that we don't have enough ammunition in terms of the demand we're getting from the official window. And that's the reason why we see quite a lot of actually demand going through the parallel market space. Then maybe coupled with the politicking that's happening now, we've seen quite a lot of demand going to that space over time. But I think the effect of this inflationary pressure and the hike in interest rate will probably be give us a bit of appreciation on the parallel markets. And we'll see probably some devaluation of the currencies on the official window. Where the convergence will happen is what it's difficult for me to predict at this point. But I think along the line, convergence will happen at the point. And you don't forget, I think on this show, when I came the last time, when they actually banned the BDC operations in the market and stuff like that. And we predicted how this would pan out over time. And I think we begin to see that effect. I'm not clamoring for that to be changed now, but I'm saying that it has an effect, especially in the case where we don't provide enough liquidity at the interbank market. I think that's effectively what we're seeing. But overall, in the long run, I think we'll probably see that some convergence, and we have to give in to the official markets probably moving from this present level to maybe the upper hand of 100.
The liquidity in the system due to political spending is beginning to expand. The central bank governor talked about how to mop up liquidity wherever you can find it. Mm-hmm. Right now, there's a lot of translating dollars into local currency because you need to spread it around within the political space.
Exactly.
This interest rate hike, what does that mean?
Well, what it means is that is just what I explained. But what will be the other effect that we're going to see are the things we need to look at in terms of how does the market react to this kind of news. We've seen quite a lot of liquidity coming from the PFAs into the fixed income market, but a lot of them actually slow down as well because everybody feels like the real rate of return is actually negative at this point. And what we'll probably see going forward is likely to see an expansion in the yield on the government curve. So we'll probably see that interest rate yield on the government bonds actually go up and on T-bills. And we'll probably see devaluations of the official FX rate. and probably an appreciations on the parallel market windows, and see a kind of harmonizations or the convergence somewhere. I think that's what I see going forward.
Okay, let's see how the market moves tomorrow morning.
Looking forward to that, actually. How the market opens tomorrow.
Steve Osho, thank you so much.
Thank you.
We appreciate your insights. Steve Osho, the Chief Executive Officer at Commercial Partners Capital.